and gentlemen, good day and welcome to the Q3 and 9 months FY2024 earnings conference call of Indostar Capital Finance Limited. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nikunj Jain from Orient Capital. Thank you and over to you, sir.
Thank you, Manuja. Good afternoon, ladies and gentlemen. I welcome you to the Q3 and 9-month FY24 earnings conference call of Indostar Capital Finance Limited. To discuss this quarter's business performance, we have from the management, Mr. Karthikeyan Srinivasan, Chief Executive Officer, Mr. Vinod Kumar Panikar, Chief Financial Officer, Mr. Srijit Menon, CEO, Indostar Home Finance Private Limited, and Mr. Pushkar Joshi, CFO, Indostar Home Finance Private Limited. Before we proceed with this call, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risk and uncertainties. For more details, kindly refer to the investor presentation and other filings that can be found on company's website. Without further ado, I would like to hand over the call to management for their opening comments, and then we can open the floor for Q&A. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. I, Karthikeyan Srinivasan, would like to extend a warm welcome to all of you for attending our Q3 and 9 months FY24 earnings conference call to discuss the financial performance of Indostar Capital. I hope all of you have got an opportunity to go through our financial results and investor presentation which have been uploaded on the stock exchanges as well as the company's website. I wish to express my heartfelt gratitude to all those who dedicated their time to join the call and have consistently been part of our journey. Joining me today are Mr. Vinod Panikar, our Chief Financial Officer, Mr. Srijit Menon, our Chief Executive Officer of Indostar Home Finance, and Mr. Pushkar Joshi, the Chief Financial Officer of Indostar Home Finance. Before going ahead with the business update, let me give you a brief on the macroeconomic factors that prevailed in the preceding quarter. The Indian economy saw a positive trend on account of increased government spending, improvement in the domestic manufacturing and services segment. GST collections increased by 13% as compared to the previous year, and both manufacturing and services PMI stayed in the positive growth zone. On the consumer side, better demand from shoppers due to increased spending in different areas led to a strong growth in the various sectors. The RBI maintained its interest rate at 6.5% and kept its stance unchanged, focusing on withdrawing support while slightly lowering its inflation forecast for the second half of this year. Looking forward, the economic outlook appears positive, with India's estimated year-on-year GDP growth for FY24 at approximately 7%. Additionally, for FY25, the GDP growth rate is anticipated to be around 6.5%, solidifying its position as one of the world's fastest growing major economies. On the CV side of it, the new CV had a muted year where the growth has been only at 1% over last year. Turning our attention to the used commercial vehicle segment, as the demand and significance of used commercial vehicle in the market continues to rise, particularly within the retail and FTU segment, it was evident that the affordability and practicality of these vehicles will play a pivotal role. In this landscape, where the price of the BS6 heavy haulage vehicles have been reaching higher and higher, the used vehicle has been the only leeway for the financially challenging profiles to get into the CV business. These segments continue to buy the used commercial vehicle segments even at a price which is much higher than what has been in the market probably 1 year back. This is predominantly because there has been a lot of change of the BS3 vehicles with BS4 vehicles. At Indostar, our mantra has been to make the life of customer better, focusing on giving a world-class experience, best-in-class experience of customer service and long-term sustainable value to our customers and stakeholders. Continuing this thought, we took various new initiatives to strengthen our deliverables and increase our presence. We are working on various aspects of business which will help us scale to newer heights. We continue to build these aspects so that quarter on quarter we will be able to improve our performance. Technology has played a very crucial role in this last 1.5 years of our growth. Our company continued to invest in various technology initiatives to remain competitive. Our focus is on making our technology infrastructure agile and flexible. We are focusing on the customer life cycle, and in this quarter, we plan to add more products so that the end-to-end life cycle of the customer can get addressed so that he can get funding at reasonable rates and not depend on unorganized players who are available in the market. We have leveraged technology to drive this and will be reaching phenomenal results going forward. We continue to focus on building our analytics to ensure that our model is agile and scalable. Our model is physical, which ensures that there is a digital touch as well as a physical touch with the customers because the profiles I am dealing with are still adopting to the technologies that are available in the world. In the quarter gone by, the company consolidated disbursements stood at 1345 crores, growing 6% sequentially. Our stated position in the beginning of the year has been that we will reduce our GNPA. We have been taking steps to reduce this. The last quarter, we resolved our corporate book. This quarter, we took one step further by ensuring that our SME book stress portfolio also goes away from the overall portfolio of the company. We did a deal with one of the ARCs with a part cash and part SR transaction so that our overall GNPA starts coming down, which will get elaborated going forward by our CFO. We have been reinforcing the financial stability and improving the balance sheet quarter on quarter, and we will continue to do this going forward also. We are expanding into our retail operations with a special focus on the used commercial vehicle segment, and focus has been on the Tier 3 and Tier 4 segments only. Looking ahead, we are committed to maintain our consistent capability to raise resources from diverse funding sources at competitive rates. Our focus remains on expanding the scale of operations so that we can increase our numbers quarter on quarter while holding on to the asset quality. Additionally, we aim for a sustained progress in profitability, consistently increasing the targeted return on total assets. We expect steady growth in the used commercial vehicle segment, as I explained, because the BS6 prices have shot up significantly. The enduring demand for the used commercial vehicle segments will be due to their efficiency in giving more cost-effective per ton rate while minimizing the downtime. Moreover, our ability to collect payments has been exceptionally strong, underscoring the resilience of our business model and trust our customers have in us. Our previous guidance remains unaltered, and we have confidence in our capacity to meet our objectives. We are actively exploring fresh products and strategies to generate additional income and enhance returns. Diversifying our product range will enable us to maintain a competitive edge in the market and provide consistent value to our stakeholders. In conclusion, I'd like to express my appreciation for your ongoing support. We are committed to sustaining our focus on growth, the quality of our portfolio, and operational efficiency. With a strong financial foundation, a healthy liquidity position, and strategic initiatives in play, we are well positioned for a prosperous and a profitable future. With that, I now pass the call on to Mr. Vinod Panikar to present the financial performance.
Thank you, Karthikeyan, and good afternoon to all of you. I sincerely appreciate your presence on this conference call today. Allow me to provide you with an overview of our financial performance for Q3 and also the 9 months FY24 that has gone by. Let's start with the net interest income. It has stood at about 133.8 crores in the current quarter as compared with 145.9 crores in the same quarter last year. Our interest margin is broadly the same that it was in last year as well. That was 5.6%. Turning to the operating expenses, it has stood at about 119 crores in the current quarter versus about 120.9 crores in the same quarter last year. Our profit after tax at about 16.9 crores was lower versus the same time last year when we reported about 36.7 crores in profitability. We have achieved our collection, a collection of about 997 crores in the current quarter versus a 963 crores in the immediately preceding quarter, which shows the amount of collection efficiency that the company as a whole has. And basis the collection efficiency, the gross collection efficiency stood at about 135% in the current quarter, showcasing our commitment to maintaining of high credit standards and also operational efficiency. Our focus on portfolio quality has led to a decrease in the stage 3 assets, which has gone down to about 5.3% at the end of the quarter. Further, our consolidated net stage 3 is at about 2.4%, demonstrating the efficiency of our credit risk management strategy, an improvement from about 3.3% that we had at the end of the immediately preceding quarter. In terms of funding, we have made steady progress and we continue to improve our liquidity position to ensure that we meet our committed targets of disbursement in the fourth quarter. We raised an incremental funding of roughly 1,422 crores to be precise, in the third quarter, in the quarter that went by. As of the end of the quarter, we had a cash and cash equivalent of about 1,312 crores. And we had a capital adequacy of 30.4% and a debt equity of about 2.1 times, which gives us ample headroom for both future growth and would give comfort to the lender of the kind of cover that they have on the lending that they do. We are confident of using this and driving the profitable growth in the coming months and quarters and years. Our AUM at the end of the third quarter stood at about 8,037 crores as compared to 7,726 crores in the immediately preceding quarter. The increased disbursement of 1,345 crores in the current quarter is slightly higher than the immediately preceding quarter when we did about 1,269 crores. And that can be attributed to the same strong focus that we have on the retail segment. Retailization efforts continue to yield favorable results, and we are confident in sustaining profitable growth in the coming quarters. In the standalone entity, that is Indostar Capital Finance, where our focus has been on CV, we have a total disbursement of about 1,074 crores during the quarter for the CV business versus the 1,000 crores that we did in the immediately preceding quarter and 334 crores that we did in the same quarter last year. We have come a long way since then. We have been it has been like a restart for us, and hence the issues of a startup keeps coming up, and with our past experience, we have been able to tackle them. While the overall book of the standalone has seen some increase, it does not reflect the 1,074 crores disbursement that we have done in the CV business. It's largely on account of the 292 crore portfolio that we sold of SME, which Karthik mentioned about in one of our steps towards reducing delinquency and having a solid balance sheet. The book was it was a stressed one, and we believe that it was appropriate to sell it off. That has made us bring down our GNPA to about 6.45% at the standalone level, which has always been a stumbling block when we used to speak to lenders for funds. While it reduced our revenue by about 7 crores in the quarter, we believe that this will yield us positive results in the coming quarters. The sale of the corporate loan book in the previous quarter of about 915 crores had impacted our revenues by about 30 crores, and it continues to on a quarter-on-quarter basis. But that would be temporary, as in the long term we will ensure that there are no hits from this. In the vehicle finance business, our AUM at the end of the quarter stood at about 4,850 crores, marking an increase of 11% over the immediately preceding quarter. As previously mentioned, our emphasis continues to be on growing the used CV segment, and we are experiencing significant growth in the AUM. Karthik did mention about the economy and the benefits that we are getting from that, which is also driving the CV segment, apart from the efforts that our team is putting. We realize that our ROA is not justified for the book that we are carrying, and we believe that the SR that we are carrying is one of the reasons for the same. We are finding ways to have the same redeemed and converted to cash at the earliest. We have in the past said that we would look at ensuring that there is no hit on account of the corporate loan book and due to SME delinquency. We have worked on it and achieved it. Now our effort is only on getting profitability. Last but not the least, would want to point out that the quarter has seen an upgrade from A+ to AA- stable. This is a testimony to the changes that we have brought about in the company, the strong promoters that we have, and the overall profitability that this would bring to us going forward. We are confident of a bright future, and we are confident that we would achieve whatever disbursement targets that we have committed in the past over the last 4 quarters. Now I invite my colleague Srijit Menon to provide further insights into the housing finance business, which is another key focus area for us. Over to you, Srijit.
Thank you, Vinod. Good afternoon, ladies and gentlemen. Let me start by wishing all of you a very happy new year. I have alongside me my CFO, Mr. Pushkar Joshi, on this call. I would like to start by taking you through the key highlights that illustrate our accomplishments during the quarter. Firstly, I'm happy to announce that we've reached a small but important milestone of INR 2,000 crores of assets under management. This achievement bears testimony of the trust our customers have placed in us. Furthermore, our active customer base has now crossed 25,000, underlining the expanding reach and granularity of the book. Speaking about the liability side of the business, we have successfully raised INR 535 crores of liabilities during the quarter. This includes the establishment of 2 new banking relationships, reinforcing not only our financial robustness, but also our strategic intent to widen the lender base. As I have mentioned in the past, we've always focused on enhancing operational efficiency and improving our customer experience. With this objective in mind, we have now gone live with the automated loan kit, which was the final leg of our paperless journey. This automated loan kit going live marks a pivotal moment in streamlining our loan cycle processes and embracing technology. This also places us amongst the select group of affordable HFCs having developed capability of e-stamping and e-signing of loan agreements, giving end-to-end digital experience to our customers. Now turning your attention to the business matrices, our customer profile mix remains balanced at 49-51 between salaried and self-employed profiles, which evens out the risk. The home loan to LAP composition at an AUM level stands at 70-30, showcasing the diversification ability to maintain yields. Our strategic vision involves expanding our total addressable market to taluka places with a population upwards of 2.5 to 3 lakhs, with a specific focus on the self-construction segment. This strategic move aligns seamlessly with our commitment of reaching a broader spectrum of customers and fulfilling their unique housing needs. We continue to remain a true blue affordable housing finance company with average ticket size of INR 9 lakhs at a portfolio level. 85% of our total disbursements are towards ticket size of less than INR 1.5 million. Out of our total disbursements of INR 635 crores for 9 months period ended 31st December 23, around 40% is disbursed in Tier 3-4 towns and cities. Tamil Nadu, AP, Telangana and Maharashtra remain our core geographies with more than 80% share of our assets under management. So our philosophy of going deep continues on that path. Delving into financial numbers, our portfolio yield stands strong at 15.1%, reflecting the prudent risk-based pricing policy that we adopt. Maintaining our spreads in the range of 5.25 to 5.5%, we continue to strike a balance between profitability and competitiveness in the marketplace. Moving to the financial performance, we are happy to report a profit after tax of INR 28 crores for the 9 months ended December 31st, 2023. Our AUM has exhibited robust growth at 26% on a year-to-date basis, with the loan book expanding by an impressive 24% on the same basis. We are taking concentrated efforts on optimization of our operating expenses and reduction in our cost of borrowing. We firmly believe that these efforts would yield higher return on asset and return on equity in the coming future. Crucially, our asset quality remains strong, with gross non-performing assets under UNAN at 1.24% and net NPA at 0.93%. Additionally, our 1+ day past due stands at 4.2% and 30+ DPD at 2.7%, attesting our prudent underwriting policy, risk management practices, and strong collection capabilities. In conclusion, the future for the company looks promising, underscoring our steadfast commitment to serving the credit underserved population of the country. Leveraging technology, developing a multi-channel distribution model, and fostering a best-in-class workforce will remain central to our growth strategy. We express our gratitude for your continued support and look forward to navigating this exciting journey together. Thank you for your attention. With this, I hand over the call to the moderator for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Vivek Ramakrishnan from DSP Mutual Funds. Please go ahead.
Thank you. My two questions are around the profitability and the sell-down books. So the first question on profitability, there is a high liquidity that you're keeping on the balance sheet, as well as your cost of funding seems relatively high compared to a AA- company. So is that acting as a drag on ROA, and what are we doing to improve that? And a related question is the cost income also. Is the operating cost stabilized for the future growth, or would you need to invest in more branches, and would it be just proportional growth? So that's the first question on profitability. I can ask a second question later if that's okay.
Yeah, thanks Vivek. Thanks for being on the call. This is Vinod. Let me address your profitability question right away. I will start by talking about the cost of funds. Definitely the cost of funds are something which is very high, and definitely not something which suits a company with a AA- rating. The reason for that is because we were away from banks till about end of June in the last of the current financial year. As for various reasons, we had not approached banks for funds. It's only after June that we started speaking to banks. Banks have been slowly coming to us, and in the interim, to ensure that we kickstart the business, we went into and got a significant amount by way of NCDs. We, I would say, collected roughly about 2,900 crores over the last four quarters by way of NCDs. So, which was at a slightly higher cost. Now that the banks have started coming in, and we have got two sanctions in the current quarter, we see that there will be a significant amount of reduction as we go forward. In the current quarter, maybe apart from the banks, we have also changed the mix of borrowing, and we have brought in securitization, which we had kept away for about 5 quarters, and we have got that at a very attractive price. We have got into other forms of CP and other things to ensure that the cost comes down. Basis this, what we are seeing is in the current quarter, while the immediately preceding quarter, my incremental borrowing was at about 12.5%. In the current quarter, it has been the incremental borrowing is at about 10.5%, which we believe is a very big positive. And the transaction happened towards the fag end of the quarter, and therefore it has not seen benefit in the current quarter. It will see benefits in the coming quarters. And now we have decided that no, now that we have opened up, we are going to banks, we are looking at other means of funding. We will ensure that the mix is such that the cost remains at this level or go down. That's one part of the question, the point that you mentioned about profitability. You also mentioned about the cost-to-income ratio. See, the cost-to-income ratio has about 3 components. Definitely the revenue. See, the revenue over the last quarter and this quarter has seen reduction. Karthik did mention about it. I also mentioned about that. We had sold our corporate book, which was a stage 2 book, because of the delinquencies that it was carrying, which actually reduced the income by roughly 30 crores for each of the quarters. Apart from that, the SME book that we sold has actually reduced the income by roughly about 7 odd crores. So roughly 65-67 crores of income has gone away, but the cost doesn't go away because it is sold partially in cash and partially in by way of SR. And therefore, it would be a couple of quarters it will take for us to actually cover up for whatever we are lost. We are lost by the CV disbursements that we are doing at 18% plus, and therefore that is something which will ensure that the cost to income is taken care of. The other cost to income ratio will definitely be taken care of when the interest cost goes down, which is what I said maybe some time back. So overall, we believe that the cost to income ratio will come down, which will lead to profitability.
So the related question was also on the liquidity. You had mentioned that you had kept, I think, 1,000 crores of liquidity, so that would also be dragging, right?
I thought I think I missed that answering that. This funds came towards the fag end. It came in the last 3-4 days or last 5 days of the quarter, and there was very little we could do to actually utilize it. Otherwise, we would be always comfortable to ensure that we keep money sufficient for 3 months of loan repayments. That's what our policy talks about. In the interim, we might find situations like this where the bank balance looks slightly bloated.
Excellent, sir. Sir, the second question is regarding the the sell downs that you have done. So how much of it is holding as security receipts? And you have mentioned in the call that you don't expect any hit. So, have they been sufficiently provided for when you sold it down? And there was also last quarter you had mentioned about an ICICI book which was causing delinquencies. So, is that also been resolved? That's my only question, sir.
I will take the first part of the question. The ICICI, I will request Karthikeyan to speak about. On the SR, last quarter, we had a transaction where of the corporate loan, and we had security receipts from that. From that, we have started redeeming it. Some of it, some negligible portion has come in the month of December. We expect a significant portion of redemption to happen in the Jan to March quarter. On the SME transaction that we did, we expect the redemption of that to happen possibly 3 to 4 quarters from now. That will not happen immediately. So we believe that that will start generating profits. Now, when I meant that it will not take any additional hit, what we meant was that no, it will remain as it is, but then for it to start generating cash, it is something, one of it will start generating in the coming quarter, or it has started generating in the December quarter, and the generation will only increase as we go forward. And the second SME that we did would start generating possibly in 3 to 4 quarters from now.
And we are also adequately provided.
Your question on provision, we are adequately provided. While we follow Ind AS, and as per Ind AS, as per the clause 7, we did not strictly follow the RBI mandate on provision under 75, 76 and 77 clauses. So we have been providing at the same rate that we provided for on the book when it was in our book. Our belief is that just because the terminology of the amount changes from a receivable to a security receipt, the realizability doesn't change. That's the reason we continued maintaining that provision.
And Vivek, just to rewind you back, last year we did a deal with one of the ARPs. We got 120 crores of SR. We have completely recovered those SR. So our ability to collect these SRs and get it back is quite high. And we believe that we are adequately provided so that no extra will be required. That's the point on SR. On the ICICI portion of it, we still have around 150 crore of book. Around 85% of it is in stage 1, 6-7% is in stage 2. So we end up having around 3 to 4 quarters every month which come into our book. In our assessment, that will continue to run like this probably for the next 1.5 years. By the time the ICICI book will run out. So in our best assessment is like around 40-45 crores will come to our book. The balance will get paid off automatically.
Excellent, sir. Thank you very much and wish you all the best.
Thank you, Vivek.
Thank you very much. The next question is from the line of Sumit Bhalatia from MK Ventures. Please go ahead.
Yeah, thanks for taking my question. Just an extension of the earlier question on clarification on SME and also the corporate book that we had sold. What is the total quantum of SR that are sitting on our books as of December end?
Sumit, good afternoon. Vinod here. On the corporate book, the SR, the gross value is at about 682 crores, against which we have got a provision of 103 crores. On the SME, we have got a SR of 160 crores, on which there is a provision of 30 crores.
Okay, so basically this 325 crore of deal that we did, 50% was in the form of SR and the balance was in the form of cash.
Correct. Yeah, broadly.
Okay. And sir, you on the overall disbursement guidance, so the sale that we have done, this was completely stage 3 book, or what was the categorization of the asset? And going forward, the balance book of SME that we have, what is your view of that? Will we be looking to do more of these deals, or so what is the time frame of rundown of the SME book? Are we looking to do that, or we'll start growing it? What is the guidance on that?
To answer your second question first, we don't intend to grow the book. That's what has been our stated position from the time we started speaking to all of you 5 quarters back. Number one. Number two is
are we looking to further do more of these deals going forward? And also the categorization of the book that we have sold, was it completely stage 3 or stage 2?
Part of it? Yeah, coming to that. Maybe I will just clarify it. What we had said 4-5 quarters back also was, this kind of SME, which is the 1.5 crore, 2 crore ticket, is not something that we want to grow. We will come back and do SME in a different avatar. Could be in a 15 to 20 lakh or 15 to 25 lakh kind of ticket in Tier 3, Tier 4, and we intend to start that process at the earliest, maybe in this quarter itself or definitely in the coming quarter. As regards the stages of the book that was sold, while the stage continue or can be stage 3, 2 and 1, all of them were stressed accounts. I would say roughly 70% of that was in stage 3 and some of it was in stage 1 and stage 2 from the point of view of the DPD. But they were accounts which were, I would say, stressed and were in stage 3 for 2 to 3 months in the immediately preceding months. That is the reason this sale happened of those accounts also.
So the balanced SME portfolio is a DA portfolio, so it will continue to be remaining in our book.
Yeah, majority of them is DA or PTC, which we cannot sell off unless we get a concurrence from the investor as well. There is a very small portion of stage 3 which is on our book, which would be roughly on our book, which we have not sold, could be about 15 to 20 odd crores. But the stage 1 which is there on a book is roughly about 220 odd crores, which continue to be there, and we'll continue to generate revenues from that unless we see some delinquencies.
Okay. So effectively the non-focus books for us was SME and corporate, and in both the segments we have degrown our book to the extent that we would have liked to. So SME from here will not degrow further is what you're saying, in a big way in any quarter, and similarly corporate in any case has come down meaningfully. So from the overall yearly annual target that you mentioned that we will not be very different from what you've guided earlier, in terms of disbursement we had given a target of around 5,400 crore. Are we on track on that? And also closing AUM, I think we were indicating something around 93,400 crore earlier in our previous calls. So how are we placed on that?
We had given a target of 4,400 plus 1,100 crores. Is the target that we have given for disbursement, 5,500 crores. And we had said that at the console level, we will be close to 10,000 odd crores. That's what we had given. So we are, both the teams, based on the liquidity that we have, are confident that we'll achieve numbers or be very close to that by the end of the financial year.
So today we are at, I think, 8,000 crores. You're saying that closer to 10,000 is still possible for us from 8,037 crore AUM.
I am saying it would be closer to, it could be roughly about 9,500 crores. That's the way I look at it.
Yeah. Obviously because of the book rundown that we have seen. So on a console basis, even that is a good number.
Maybe one more reason was the two sales that we did, 915 plus close to 300, roughly 200 odd crores was sold by us.
Right. So one question on housing book. The P&L looks little weaker on a QOQ basis. I might have missed out something. So can you please help us on that? And also on a sequential basis, disbursements have also not picked up. Any specific reason for that?
Yeah, hi. This is Pushkar here. Good afternoon. So I would like to take the first part of this question. So on the profitability side, the major dip on the profit is on account of the reduced upfront income book in the quarter 3. So in the quarter 2, we sold our LAP portfolio worth around 108 crores. As against that, we sold only 25 crores in the quarter 3. So that's the major reason why the profitability is dipped. I would like to request Srijit to take the second part.
On disbursements, this year, as I mentioned earlier as well, our focus has been to balance out the spreads, the yields, and the ticket size. So we continue to play the small ticket game, and we also had to balance out the liability side. So it's been more deliberate to keep it at that numbers. Now that we have a full line of visibility on the liability side, we have built capacities now to grow the disbursements from here on.
Okay. Just one last question on profitability. On a consol basis, we were looking at around 2.5% kind of a range for ROA for FY25. Are we on track to achieve that?
We are on target to achieve that because that's the number that we gave and we are working towards achieving that.
Okay. Okay. Thanks so much for the response.
Thanks. Nice speaking to you again.
Yeah, same here.
Thank you very much. The next question is from the line of Harsh Shah from Reliance General Insurance. Please go ahead.
Hello, sir. Sir, so you said that we'll be able to have a AUM growth of approximately closer to 10,000 for this year. Sir, with a disbursement which is closer to 600-650 crore, so would like to understand how we'll be able to reach that.
Harsh, hi, Vinod here. See, the disbursement is not 600 crores. The disbursement is in the range of about, both together was in the range of 1,300 crores, roughly about 1121 crores in the standalone, and both together about close to 1,300 crores. This is the one number which we intend to ramp up in the 1,345 crores to be very precise. This is the number that we both are confident, both the entities are confident of ramping up in the fourth quarter, and we should see the number. Today we are at about 8,000 crores AUM. So both together, if we do a disbursement of close to 2,000 crores, we are confident of being close to that number, because even with the rundown which will happen in the normal course.
Okay, sir. Got it.
Thanks, sir.
Thank you very much. The next question is from the line of Deepak Poddar from Safar Capital. Please go ahead.
Hello. Am I audible, sir?
You are, Deepak. Kindly go ahead.
Yeah, thank you very much, first up, for this opportunity. So first up, I just wanted to understand in terms of growth, you mentioned about 9,500 crores this year. So how do we see that over FY25 and 26 in terms of advances? What sort of target we have?
Deepak, in the previous calls, we had said that our aspiration is to do about 6,000 crores in the standalone and about 14 to 1,500 crores in the housing finance. That together should take our number to close to 13,000 crores by the end of the next financial year.
FY25, 13,000. And what about FY26?
I would want to restrict it to 25 right now. I don't want to be giving too much of forward-looking answers.
Fair enough. I got it.
Sorry about it.
And in terms of your ROA strategy, I wanted to understand, more 2% ROA, 2.5% ROA. I think currently our ROA is 0.7%. So in next 4-5 quarters, I think journey from 0.7% to 2%, and that's the average. So ideally, you have to end your year with a much higher ROA. So I just wanted to understand, so what's the strategy that we are likely looking at to bridge this gap of ROA? So where all the improvement is likely to come that will boost your ROA?
I thought I answered it when I answered Vivek, but I'll repeat it. First is on the revenue front. We said that we were losing roughly in the standalone, roughly about 35 to 37 crores on a quarterly basis, and it will take about 3 to 4 quarters for it to start going away, that impact of that to go away, because the disbursement in the CV portfolio is significantly high. So, which is also at 18%. So, that will definitely come in. We are also looking at starting with LAP. I mean, not LAP, I mean the SME, definitely in the coming year, which will be an additional benefit to the bottom line and therefore the ROA. Cost of funds is something which I mentioned about. We have changed our mix, basis which the cost of funds have reduced. The incremental borrowing has reduced significantly in the Q3, and we expect that trend to continue. And with the banks also warming up to us, we are fairly confident that the overall cost of funds would go down. Today, in Q3, it has been exorbitantly high at about 11.7%. So we are confident of that coming down to a 10.5% kind of level, possibly for the major part of the next year. And revenues also going up. That's number 2. Number 3 is basis my book going up with a not very proportionate kind of increase in my OPEX. I definitely expect the ROA as a percentage to also significantly improve, because cost to my OPEX currently is at about 4.5% of the total asset. That is something which we see going down to about 3.75 to 4%. It's a combination of all these things, and all will happen simultaneously. All are currently happening simultaneously. Maybe I will be incomplete if I don't cover the last point. I also mentioned about SR. That is, our aim is to see how do we monetize and get the SR redeemed at the earliest. So that's one focus area that the company has going forward.
Yeah, that's very helpful, sir. But will it be safe to say that, from current ROA levels we stand on a quarter-on-quarter basis, every quarter we should see some improvement?
We should see that.
We should see that. Okay. Fair enough. I think, that's it from my side. All the very best to you. Thank you.
Thanks, Deepak. Thanks for being on the call.
Thank you very much. The next question is from the line of Vibha from Fair Connect. Please go ahead.
Yeah, thank you for taking my question. My question is, I'm just trying to relate your income from CV balance sheet. So if you were to look at your income of 666.38 crore, how much of it is from on-balance sheet CV portfolio? And what would be that portfolio? I can see in your presentation the AUM is 4850 crores, but out of that, some could be your securitized book or assigned book, and where income is booked differently. So I'm looking at your on-balance sheet assets in CV and corresponding income.
Good afternoon, Vibha. Vinod here.
Good afternoon, sir.
We have negligible amount of DA, which is, I would say, off book. Everything else is on book. In case you specifically mentioned about CV, I'm responding to the CV part of it. We have a book of about 4,850 crores, and the entire thing actually generates that kind of revenue. Generates the revenue for the organization. It's only internally we have possibly split it up as what is organic, what is inorganic, and some part of it which comes from the ICICI book.
Okay.
But everything is on the book. We have got nothing outside.
Okay. So your total book is 5,454 crores. Out of that, CV is 4,850 crores. What is balance?
5,454 crores is the on book. The overall is
loan book. Yeah.
It's actually 5,800 AUM. 4,850 crores is the AUM. 4,850. On book is slightly lower. It is at about 4,000, close to 4,666 to be very precise.
Okay. And rest is the securitized book.
Rest is the DA book, because securitized comes on to the book.
Okay. Okay. And how much is the interest income out of this 4,666?
The entire amount that you mentioned comes out of that.
But that would include your income from bank balances and other things, right? Interest income, part of it will be coming from the CV portfolio and part would be from other, So I'm looking at purely CV income. What I'm trying to reconcile is what is your yield, because your book yield is 18.9%. But if I were to compare this to your earning assets, it's pretty deflated, partly because you have large amount of SRs and, other assets. So,
Because the income coming from the vehicle finance business interest income is 481 crores. You also mentioned about the 18.9%. Now, 18.9% is the incremental disbursement that we are doing. We are roughly about 4,800 crores of book. And over the last 4 to 5 quarters is what we have been disbursing at that rate. The older book where we had a large amount of new portfolio was at a significantly lower rate. So the weighted average income for the CV would be in the range of 16%.
Oh, okay. But actually, if I were to relate this 481 to 4666, it's and annualize it, a very rough calculation, it's 13.74%. And your NPAs are not very significant now. So why is there so much of dilution?
Our numbers are that I said 16 at 16.8. We can definitely possibly take it offline, and then we can confirm our numbers with you. We stand by our numbers.
Okay, fair enough. Just 1 or 2 more questions if I can take. There is this goodwill of 300 odd crores.
Sorry, Vibha, can I just hold you for a minute? The 4,850 or not numbers they are saying is the number at the end of the quarter. The income generation happens on the average loan book, which is a daily balance.
Yeah.
Sorry, you will continue. 300 crores of goodwill. Please continue.
I understood the question, but since I didn't have the numbers during the quarter, I just took the rough this thing. But of course, this may go up because the growth is not very significant. The 13.74 may move up, but not very significantly. But I will definitely take it up offline with you. This goodwill of 300 crores, that and SRs, you said majority will be redeemed. So the balance sheet, your yield will start improving only when these non-yielding assets go down. And third is that you said that you would want to keep liquidity for 3 months. 3 months of what? Disbursements, your repayments, and broadly in relation to your earning assets, what would be that percentage? Because right now, the profitability is very depressed because your earning assets in relation to overall assets are really low.
Yeah,
so just a trajectory on these.
Yeah, Viva, liquidity I mentioned was 3 months of the repayment that we would need to do. So the repayment would be in the range of close to 450 to 500 crores. That's the one part. On the SRs, in fact, I did mention about it that we would need to monetize it. We would need to get it redeemed at the earliest. So that efforts are on that to ensure that the SRs get redeemed and therefore it starts getting converted into cash, which is redeployed into the business and therefore start generating yields. On the goodwill part, there is no provision under Ind AS to amortize it, so that would continue to be there. But then that is something which has come basis a transaction which we did in 2019, where we bought over the CV business of IIFL, and it was for that point of time, and that is what has helped us grow to the level that we grew or we have grown so far. It gave us the reach.
Okay, but when will it be amortized? It will stay on the books forever.
Sorry to interrupt, Vibha.
Yeah, it will not get amortized. The Ind AS doesn't have a provision for that. Under Ind AS, and we follow it.
Okay. Just a follow on, this goodwill will be knocked off from your network.
Sorry to interrupt, Vibha. Can you join again?
I will join, but just an add-on on. My question hasn't been answered.
Vibha, we can do a detailed call separately. I am a call away.
Sure. Thank you.
Thanks, Vibha. Thanks for taking the call.
Thank you very much.
You.
The next question is from the line of Tushar Sarda from Athena Investment. Please go ahead.
Yeah, thank you for the opportunity. You've given guidance on ROA, but your leverage is low. So, in what time period leverage will increase and the ROE will catch up? How would it be in FY25 and FY26 in terms of leverage?
we will be happy with a leverage of about 4 to 4.5 times. But that will be some time away. I don't see us going to that level even in 25.
But not even in FY26.
26 we should be there, but 25 I don't see us going to that level.
So with 2.5 ROA and 4 leverage, your ROE will be just 10% or so. Is that right?
You're right, right, I would say. But then I would say that we will need to look at other ways and means, because on how do we do securitization, how do we do BA and other things to ensure that it is not taken as a leverage, but at the same time you generate income. So that's something which will continue to be there, and I think all NBFCs keep looking at ways and means to do that.
So do you have a ROE target? Because I don't think you've guided for that. You've guided for ROA. So
no, we have guided for ROA. We are currently not guided for an ROE.
Okay, but do you have a target for that? Can we look at some number in terms of ROE?
I mean, right now we are not. I would say discussed that outside, but we have currently stuck ourselves to the discussion of the ROA only. Permit me to.
No problem. No problem. I just wanted to.
Great to Tushar.
Yeah, and I have one clarification on this slide 17. You have collection including overdue and then overall collection. So what is the difference between the two?
Give me a second. So you are referring to
collection efficiency slide number 17 in your presentation.
There are 3% floating around. One is billing efficiency. There is bill to bill. So what is
that? I understood. No, there is a collection including overdue and there is overall collection.
I am giving you the details of all the three. Collection including overdue means I have collected something for this month plus I have collected something for the previous month. So that is collection plus overdue, which was overdue in the in the month.
Yeah.
The third part is the case. It includes the prepayment. There are many who would want to pre-close it and things like that.
So prepayment is huge. That means every month.
You will keep finding that because people would want to, once they, the kind of customers that we have, our customers, many of them are FT first-time users. So they come in, they build up their credit profile by paying to us on time for a year and a half. And then obviously we are expensive at about 18%, 18.5% ROA, yield. So they always look out for a better, for a lower cost, which we will not provide. They will go to somebody else. Okay.
And so they repay the whole loan or just part of the loan? And what happens to the EMI?
And that's why it's called foreclosure. He closes it and then he goes to somebody else with his truck.
Okay.
He gets the extra funding.
Okay. Thank you.
Thanks, Tushar.
Thank you very much. The next question is from the line of Shubhradeep Mitra from Nippon Mutual Funds. Please go ahead.
Hi, thank you for the opportunity. So I have 3 questions, sir.
Sir, you're not audible.
Hello.
Shubhradeep, you're not audible. Huh? Could you speak a bit louder, please?
Hello. Is this better?
Yeah, you're perfect. Good.
Yeah. So, sir, I have 3 questions. One is that there is a marginal increase in the corporate book in absolute terms, whereas our guidance has been not to grow this book. So that's the first question. Second
I will answer the first question first.
Sure, sir.
See, while we have said that we will not be doing corporate loan in future, there are certain commitments based on the old sanctions that have been given by us. And we are the sole lenders to those projects. We cannot be not disbursing for those projects at least. So I think in the previous quarter, possibly you were not on the call, but then we had said that over the next 4 to 5 quarters, you would see roughly about 20, 25, 30 crores kind of disbursement every quarter.
Sure. Thanks. That helps. The second question is that you mentioned that the provision on the SRs that you have received now is around 30 crores on an SR of 160 crore, if I heard you correctly. So don't you feel that those provisions are on the lower side? What's your take on that?
No, these are provisions which have been determined. This is the ECL methods that are followed by us, and we have retained the same provision that we were, percentage of provision that we were keeping when the asset was on our books. So when it has become an SR, we have not changed the provisioning. In fact, Ind AS doesn't require you to make provision. We thought it is prudent or conservative on our part to make provision. That's the reason we have retained it.
Understood. Thank you so much. And so the third question is, from the banking sector, how much sanctions did you receive during the quarter? Can you give us some number on that?
One in the form of term loan, one is in the form of WCDL, and 2 sanctions in the form of securitization.
Sure. And how much would that be, sir?
That would be totally 4. All put together roughly about 640 crores.
Sure, sir. Thank you so much. That's all from my side.
Thanks, Sudhir.
Thank you very much. The next question is from the line of Rikesh Parekh from Rockstud Capital Limited. Please go ahead.
Yeah, thanks for the opportunity. Sir, my question is related to the branch expansion. In last year, we have opened almost like 70 branches. And so going forward, annually, what kind of branch expansion we are looking at, or are we done with it?
Plan to add some 40-50 branches. Mortgage, I think, the housing, they have already completed their expansion.
The 60-70 increase which has happened is most of it, I would say, is in relation to the housing finance business, where they have expanded into newer territories. And like Karthikeyan said, that they have possibly come to the tag end of their expansion mode. Now I think they will try to monetize from there.
And just related to that, wanted to understand what is the break-even time to reach in a branch, and what target do you look at average branch should be getting? Because if I look at it, it is like 3 crore or so the number comes out based on disbursement if I look at it.
See, we discussed, I think, these are all not lavish branches. These are all very small branches, wherein I put a person, he starts disbursing 5 units per month. In the 6th month, it will become break-even. So his average of 2.5 to 3 crores, the branch turns around. And that's the kind of infrastructure spend we are doing also. So we don't see it as a major cost, but it will be coming at a much lower cost, and it will be coming at interiors where we will be able to get our rate.
And the average time it takes to break even?
6 months, worst case 6 months.
Okay. And so just last question, if I may, on provisioning, we are at 50% coverage ratio now after downselling and other things. So what will be the comfortable level you will be looking at over the next 1 year?
See, we will continue to hold around that percentage only. We will have a relook at our PD, LGD in the March quarter, then take a call if we need to reduce. If you look at the industry, we are one of the highest in terms of stage 3 PCR. So we will have a look at it in March because we have seen our portfolios improving quarter on quarter. That's reflecting in the numbers which we have been reporting also. So in March, we'll be able to give you a firm view.
Okay. Thanks. Thank you for me. That's it from me.
Thanks, Rikesh.
Thank you. In the interest of time, that will be the last question. I will now like to hand the conference over to Mr. Nikunj Jain from Orient Capital for closing comments.
Yeah, thank you. I would like to thank the management for taking the time out for this conference call today, and also thanks to all the participants. If you have any queries, please feel free to contact us. We are Orient Capital, Investor Relation Advisors to Indostar Capital Finance Limited. Thank you so much.
Thank you, Nikunj.
Thank you, everyone.
Thank you, everyone.
On behalf of Indostar Capital Finance Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.